Hi everybody, this is lecture for week 7 and this is lecture 1, supposed to be on Monday 8 a.m. 29th of November. Okay, last week I have done lectures on topic 5, which is a topic about the preparation of financial statement. The financial statement is the final output of financial accounting. So basically, you have learned from topic 1 to topic 5, you have learned how to do financial statement, how to prepare financial statement, how to do accounting record for a business. The output of the final output of that accounting process is the financial statement. So you can see I have told you the income statement shows whether the business is making profit or loss, and the balance sheet shows the financial condition of the business. If a business is making profit, then in accounting we say that the business is performing well. If the business is making loss, then we say in accounting the performance of the business is not good. But that are the general statement or conclusion. Actually, you will not know the actual performance and condition of a business if you do not do financial statement analysis. In other words, if you want to know the actual performance of a business and the actual condition of a business, you have to do financial statement analysis. After you have done the analysis, then you can make a good conclusion from the financial statement. Okay, let's see. This financial statement analysis is the topic 6 in this course. So let's see. So this is like the introduction to the topic. See here, the purpose of analysis. Okay, why people do financial statement analysis? Businesses, they produce or publish financial statement, and then people analyze the financial statement. So why people analyze the financial statement? See here, the orange box here. Common goal of financial statement analysis for both external and internal users is to evaluate the company or business performance and financial condition to assist in evaluating, first, past and current performance, second, current financial position, third, future performance and risks. Okay, so here it is said that there are 3 purposes of doing financial statement analysis. One, to know the performance of a business, the past performance and current performance, and also financial statement analysis is done to predict the future performance of a business. If you do financial statement analysis, you can predict in the future the business is going to be performing well or performing badly. And then second, people do financial statement analysis to know the current financial position of the business. Financial position is related to debts of the business. If the debts are high, the business is said as not in a good financial condition. If the debt is low compared to the total asset, then we say in accounting, we say that the business is in a good financial condition. And future performance and risk. Another purpose to do financial statement analysis is to identify problems with a business. If one day in the future you see a business is making loss for several years, or so you want to know why the business is making loss. So one of the way to know the reason why such problem happen in a business is you do financial statement analysis, and then you will see, oh, this is the problem, this is the reason. So and then you can make corrections. Hopefully the business can be safe and make profit in the future. Okay, just to remember this, people who use the financial statement of a business can be categorized into two groups: internal users and external users. These people, I have explained these people, I think in topic 1 or topic 2. They use financial statement for different purpose. Each user has a purpose, and they will analyze the financial statement for their own purpose, for their own reason. Like managers, they use financial statement to manage the day-to-day operation of a business. So when they will analyze the financial statement for their reason. Shareholders or investors, they use financial statement to make investment decision. So they analyze the financial statement for that purpose. Okay, so this is the building blocks of analysis. For this course, you will learn that analysis of financial statement can be done to assess or to examine the liquidity and efficiency of a business, the solvency of a business, and the profitability of a business. Okay, information for analysis. This topic is about financial statement analysis. So what are the things that we will analyze? These are the things that we will analyze. The thing that we will analyze in this topic, and the thing that you will learn how to analyze, is the general purpose financial statement. Remember, the financial statement contains 5 components: income statement, balance sheet, statement of equity, statement of cash flow, and notes to the account. Notes to the financial statement or notes to the account. But for this course, we focus on 1, 2, and 3. Income statement, balance sheet, is statement of equity only. Okay, standard for comparison. When you analyze something, you have to compare, so that you can make conclusion, this thing is good or not. Same goes to this financial statement analysis. When you do financial statement analysis, you have to compare the analysis with something, company A and company B, to check which company is better, company A and the industry average. There are many industry out there, construction industry. There are many companies in the construction industry, financial industry or financial sector. There are many companies there, banks, insurance, etc. So if you want to make analysis, you can compare with data of industry or sector average. Company A compared to the average of companies in its industry. Let's say company A is a construction business. So to make the analysis, you can compare company A data with the average of the same data for the construction sector or industry. So you can make a conclusion. So whether the company A is performing better than the industry average or less than the industry average. So see here the red box there. When we interpret our analysis, it is essential to compare the results we obtain to other standards or benchmark. So see here later, you will see that when you have to do financial statement analysis, you will compare data of a business and something else to see whether the business is good or not. So the comparison can be done using four ways. Intra-company means you can compare company A and company B, one company and other companies, or you can do comparison with competitor. Company A, you compare the data of company A with the data of the competitors of the company A. So you will know whether the company A is better than the competitors, or same or as good as the competitors, or worse than the competitors. So there is one way. Number 3, you can compare to the industry data, like I said earlier. One construction business data can be compared with the average of all construction businesses in Malaysia, for example, or in India or China or USA. So you can compare with industry data. Malaysian company can be compared with Malaysian industry data. China company, you compare with China industry data. You cannot compare Malaysian company data with China company data or with USA company data. You cannot do comparisons like that, because you have to compare with something that is relevant for that business. Guidelines. Sometimes you can compare one company data or business data with the guideline provided by the regulators or industry or regulators. Most of the time regulators, or maybe law, if there is any regulation related to law, guidelines related to law. Okay, tools of analysis. Okay, here tools of analysis means the methods that can be used to analyze the financial statement. There are many methods that can be used to analyze financial statement. The first method is called horizontal analysis. Horizontal analysis is a method in which you compare the financial condition and performance across time. Company A data, you compare with the same company's data but previous year data. Vertical analysis, you comparing the financial condition and performance to a base amount. For vertical analysis, imagine there is a vertical line. So you compare data of a company with the total. So the thing is something like this. When you analyze an income statement, you compare the total sales with the total profit during the year for one business. So one data with of the same company with the total data of the same company. Balance sheet, you do the same thing. One data from the balance sheet compared with the total data in the balance sheet of the same company of the same year or accounting period. If you have time, you can check the textbook how to do the horizontal analysis and how to do vertical analysis. Very interesting, these two methods. The third method or tool that can be used to analyze financial statement is called ratio analysis. Ratio analysis is measurement of key relations between financial statement items. So for this course, the focus is on the ratio analysis. So in this course, you will learn how to use ratio analysis to make financial statement analysis. Okay, let's see how many ratios. You have to know several ratios. Okay, now we are focusing on define and apply ratio analysis method. Okay, for this ratio analysis explanation, I will refer to this balance sheet. Okay, this balance sheet. See the data here. You have the soft copy of this lecture notes, so you can check the lecture notes. So here there is a list of all assets. So this is a balance sheet of a business. Before this, in the previous topic, I have explained about how to prepare a balance sheet, and then the format that we use in topic 5, format of balance sheet that we use in topic 5 is called T format. But here it is a balance sheet, but the format that is used here is called statement format. Statement format, you have to list all the assets here, see, and then after that you list all the liabilities, and then you list all the equity account. The content are same, but the format is different. Okay, so let me explain a bit about the list here. You can see here assets of this business. So this this balance sheet is a bit complex, because this balance sheet is a merchandising business balance sheet. See here, cash, and then short-term marketable securities. Short-term marketable securities is like a short-term investment. And then account receivable, you know, account receivable. Inventories are things that the business sells. Vendor non-trade receivable, it is a current asset, but it is less liquid current asset. Very difficult to convert to cash. Quite difficult, not very difficult, difficult to convert this asset into cash. Other current assets, so you see here, and then after that you see a total here 162,000 or million, or 162 billion maybe, because the unit that they use here is million. So 162,000 million. I'm not sure about the number, but it says here the number is in million. And then there are a list of non-current asset, long-term marketable securities, property, plant, equipment, and other non-current asset. Okay, liabilities, account payable, you know. Other current liabilities, you know, deferred revenue, I think unearned revenue. Commercial paper is a short-term borrowing, if I'm not mistaken. Current portion of long-term debt. Okay, this is also a current liabilities, but it is part of the long-term debt. And then that is the total current liabilities, see there, and then long-term debt, and then other non-current liabilities. There are two long-term liabilities. Okay, and then stockholders equity. Okay, equity means amount owned by the owner of the business, amount owned by the shareholder of this business. Common stock, retained earnings, accumulated other comprehensive income. And then you see here total stockholders equity, and then you see here the total liabilities and stockholders equity. Total assets are equal to the total liabilities plus total equity. So there are 2 years data, and then the red numbers there, you can see that red numbers, these 2 numbers are the comparative data, the difference between current year data and prior year data. Okay, this is the balance sheet, and this is the income statement. for this business. So like I said earlier, this business I think is a manufacturing business or a merchandising business. So that's why the income statement is a bit complex. Apple Incorporated, I'm not sure whether the data is actual data from Apple Incorporated or this is just like a sample company. I'm not sure, but just use this data. Okay, let's see that. Net sales is 260,174 million according to this slide. And then cost of sales is 161,782. So gross margin. Okay, remember, sales revenue minus cost of sales, you will get gross margin or gross profit. And then gross profit, you have to minus expenses, research and development, selling, general and admin expenses. And then you get here total operating expenses 34,462 for current year. So operating income is 63,930. Other income 1,807. Income before provision for income tax 65,737. Provision for income tax 10,481. Net income 55,256 million. See here, this is a company. When there is for a company, it has to pay corporate tax. It has to pay corporate tax. But if you have a sole proprietorship or a partnership, you don't have to pay corporate tax. The owner of the business will have to pay personal income tax. Okay, so these are the data that we will use in the explanation about the ratio analysis. See here, okay. See, the ratio analysis that you will see here is related to liquidity and efficiency ratio, solvency ratios, and profitability ratios. Okay, now we look at the liquidity and efficiency ratios first. Ratios related to liquidity and efficiency that you have to know is current ratio, acid test ratio, account receivable turnover ratio, total asset turnover ratio, and working capital. Working capital is not a ratio, it's just a calculation. Okay, liquidity. Okay, what it means by liquidity? Liquidity means, in a simple way, liquidity means how good the business in terms of having cash. Cash is very important for a business. If you have a business, cash is very important because you have to use cash every day. You have to use cash to pay worker salary, to pay creditors, to pay banks. If you have a bank loans, you have to pay utilities, rental. So cash is very important. If a business does not have sufficient cash, then the business is having a big problem to survive. Very difficult for the business to survive. Efficiency is related to how good the business in its operation. Efficiency is related to how fast the business can sell or can produce, and also how good the business in operation, in its operation, do the operation without many wastage. Okay, efficient is related to that thing. Okay, so let's see liquidity and efficiency. So I think the current ratio, working capital, and acid test ratio are related, are ratios that are related to liquidity, and account receivable turnover and total asset turnover are related to the efficiency of the business. Okay, this is the working capital. Working capital is the amount of current asset minus current liabilities. So if somebody asks you to calculate working capital, then the way to calculate that is current asset minus current liabilities of a business. So how to get the data when you want to do when you want to calculate working capital? You have to check the data in the balance sheet of the business, because current assets and current liabilities are listed in the balance sheet of the business. You cannot find the data in the income statement now. So you can see here there is an example. You can refer to the income statement and balance sheet that I have explained in the previous slide. So here, see the current asset in the current year is that much, 162,819. And then current liabilities in the current year is 105,718. Working capital is 57,101. And in the previous year, the working capital is 15,410. So it shows that the current year working capital is higher compared to the previous year working capital. So in this number shows that there is an improvement in the working capital of the business. Working capital is related to liquidity of the business. So we can say that there is an improvement in the liquidity of the business according to the working capital, according to the number or figures of working capital. Okay, now the second ratio that you need to know related to the liquidity of the business is the current ratio. See the blue box there? This ratio measures the short-term debt paying ability of the company or the business. A higher current ratio suggests a strong ability to meet current obligations. So if you, in the future, let's say you have extra cash, you want to invest in a company, like I said earlier, if you see the financial statement only, you can make general conclusion. But if you want to know what is actually the condition and the performance of the business, you have to do the financial statement analysis. So if you want to know the ability of the business to pay its debt, then you can do current ratio analysis. Current ratio, like mentioned in this slide, measures the short-term debt paying ability of the business. The higher the ratio, the better the business in terms of its ability to pay short-term debt or current liabilities. To pay current liabilities. So see here, current year the current ratio is 1.54. Previous year the current ratio is 1.13. So the business, according to this number, the business is getting better in terms of its ability to pay short-term debts. So acid test ratio. acid test ratio is another measure of liquidity, but acid test ratio is more strict compared to the current ratio. See the gray box there? This ratio is like the current ratio but excludes current assets such as inventories and prepaid expenses that may be difficult to quickly convert into cash. Okay, so how to calculate acid test ratio? So you have to use this formula: cash plus short-term investment plus current receivables divided by current liabilities. So cash is referred to as quick asset. Why it is referred as quick asset? Quick asset means cash can be converted into other type of assets very quickly. You have cash, you can change cash or convert cash into other assets such as building, land, motor vehicle, equipments very quickly in several seconds. How to do that? You just purchase. You have $100,000 cash, you can purchase maybe a small piece of land, you can purchase equipment. So that's why cash is called quick asset. Okay, so same like current ratio, the higher the acid test ratio, the better the business in terms of liquidity. So if you compare two businesses, company A, the quick ratio is, the acid test ratio is 1.7. Company B, the acid test ratio is 1.9. So which business is better in terms of liquidity? Company B is better because it has a higher acid test ratio. You can compare two different companies. You can compare one company data, current year and previous year, or you can compare one company data with industry average or with guideline or with competitors, with the company's competitors. So for this ratio analysis, you have to know how to calculate the ratios, and you have to know how to interpret the ratios, and also you have to know to make comparison. You have to know how to make comparison between the business data and other data. Maybe you have to compare with other companies, competitors, industry average, or guidelines. Okay, this is account receivable turnover. This ratio is related to the efficiency of the business. Account receivable turnover, the way to calculate that ratio is account receivable turnover equal to net sales divided by average account receivable. Okay, so how to calculate net sales? You can get the number of or the figure for net sales from the income statement. Net sales are the total sales minus sales return and minus sales discount. So, but you can get that number from the income statement. Divided by average account receivable. So, how to calculate average account receivable? See here the white box there. Average account receivable equal to beginning account receivable or current year account receivable plus beginning account receivable plus ending account receivable divided by 2. Then you will get the average account receivable. So in the gray box there shows how to calculate the account receivable turnover using the data in the sample sample balance sheet that you have seen in the previous slide, and also data from the income statement in the previous slide. Net sales, see there, 174, and then the average account receivable is equal to 23,100 plus 22,926 divided by 2. So equal to 11.3 times. These ratios measures how many times a company converts its receivable into cash in a year. Okay, so for this business, it shows that this business converts its receivable into cash 11.3 times a year. So the higher the higher the account receivable turnover, the better the business in terms of its efficiency to convert its receivable into cash. It shows that how good the business collect cash from its account receivable. Days sales uncollected. Okay, this one is another way of measuring the efficiency of a business. This ratio measures how frequently a company collects its account receivable. So what is the difference? This one, how many times a company converts its receivable into cash. This one, how frequently a company collects its account receivable. Okay, see here, days sales uncollected. So the formula is in the gray box there, or in the black box there. Days sales uncollected equal to account receivable net divided by net sales times 365 days. So for this business, see the data is coming from the sample income statement and balance sheet of in the previous slide. So 22,926 divided by 260,174 times 365 days equal to 32.2 days. Okay, so if you are asked to calculate days sales uncollected, you use this formula. And then total asset turnover. This is easier to understand. Total asset turnover, see the bottom box there. This ratio measures a company's ability to use its asset to generate sales. It is an important indication of operating efficiency. So the formula to calculate the total asset turnover is net sales divided by average total assets. Average total assets equal to beginning assets plus ending assets divided by 2. So if we use data from the sample income statement and balance sheet, for the current year, net sales equal to 260,174 divided by average total asset. Average total asset, the beginning is 338,516. The ending total asset is 365,725. And then you divide these numbers by 2. You will get 0.74 times. So it means that for every $1 of asset, the business can generate 74 cents of sales. So the higher the total asset turnover, the better the business in terms of its efficiency in using its assets to make sales. Okay, I stop here. This is part 1 of this of lecture for this topic. I stop here. This is part 1 of the lecture. Later, we will see solvency ratios and the what is the next one? Solvency ratios. And there is another one. Thank you very much. Do not forget to write your name and metric number in the comment section. I will take that as the lecture attendance.